All right, let's talk Goldman Sachs because they just put up an absolutely monster quarter. So we're going to dig into their Q4 earnings and show you exactly how this back-to-basics strategy of theirs is paying off. And I mean paying off in a huge way.
So it all really boils down to this one number, $14.01. That is the earnings per share. And honestly, it's the key to understanding just how massive this quarter was for them. And look, make no mistake about it, this wasn't just a good quarter. This was a statement quarter. Goldman came out and just completely smashed Wall Street expectations right across the board. You know, the scale of the beat is what's really incredible here. Think about it. Wall Street was looking for, $11.67 a share? Goldman comes in and drops over $14. And revenue? They blew past the forecast by almost $500 million. This was just a clean sweep. A clear outperformance on every single metric that matters. In this chart right here, it really drives the point home. It's one thing for me to tell you the numbers, but when you see it laid out like this, that gap between expectation and reality is just massive. That taller bar, that shows the company firing on all cylinders. Okay, so how did the market react to all this? Well, with a huge vote of confidence. The stock jumped more than 4.6%. And what's really interesting here is that the options market, the folks betting on how much the stock will move, they were only pricing in about a 2.5% swing. What does that tell you? It tells you this result caught a lot of people off guard, and it probably forced anyone betting against the stock to scramble and cover their positions.
All right, so the big question is, where did all this strength come from? Let's pop the hood and look inside the engine room, see what really powered this thing.
What's so impressive is that this wasn't just one part of the business carrying the team. The strength was everywhere. I mean, you had record revenue in equities trading, up 25% year over year. FICC trading was super strong. Investment banking fees surged. Heck, even their more stable wealth and asset management division hit record fees. This wasn't a one-trick pony. The whole machine was humming.
And this chart here really gives you the breakdown. You can see that global banking and markets is still the absolute powerhouse, right? It's the core driver. And when that engine is firing like this, it just lifts the entire company.
Now, a quarter like this doesn't just happen by accident. Nope. This was the direct result of a very deliberate, multi-year strategy shift. A real, back-to-basics blueprint that is now, finally, paying off big time. And you don't have to take my word for it. Here's the philosophy, straight from the CEO, David Solomon. He talks about this M&A flywheel. And this concept, it is the absolute core of their entire strategy. You land one big advisory deal, and it just spins off all these other opportunities, financing, hedging, you name it. So this whole strategy involved a really clear pivot. They moved away from some of the riskier consumer banking stuff, like getting out of the Apple Card deal, and they doubled down on what Goldman has always done best: institutional trading, advising big companies, and high-margin wealth management. They basically simplified the whole story and focused on their core DNA. And the proof, as they say, is in the pudding. Or in this case, the numbers. They advised on almost $1.5 trillion in M&A. Their pipeline of future deals, it's the highest it's been in 4 years. And with assets under supervision now topping $3.6 trillion, what do? They raise the dividend. That's a huge signal to investors that management is confident this isn't just a flash in the pan. Okay, so that was the story of Q4. Let's shift gears now and look down the road. What's the guidance? What are the catalysts that investors should be watching for in 2026? Management was actually pretty clear about the timeline here. So in the first half of the year, they're expecting a pretty solid IPO pipeline to start converting into actual fees. Then by mid-year, they're looking for private equity firms to really start putting their money to work. We're talking about $1 trillion in cash or dry powder that's been sitting on the sidelines. And all the while, that M&A momentum should just keep that flywheel spinning faster and faster. So what's the one big variable in all this? What's the key to making it all work? It really comes down to the health of the capital markets. As long as the environment for making deals stays strong, Goldman is just perfectly positioned to capitalize on it. Let's just double-click on that M&A flywheel idea for a second because it's so central to everything they're doing. See, it's not just about getting one big fee from an M&A deal. That one deal creates this whole ripple effect. Suddenly, you've got business financing the deal, hedging all the new risk, managing the wealth of the execs involved, and on and on. It's a powerful multiplier, and Goldman has put itself right in the middle of it all. All right, time to put it all together. This is the next call. Here's our take on what's coming next for Goldman Sachs.
Our prediction here is pretty straightforward. We think the momentum continues. That investment banking backlog they talked about, that's not just a number on a page, that's future revenue waiting to be booked. We're expecting another really strong quarter as that pipeline starts to convert.
So, based on that fundamental strength, our call on the stock's price action is that we expect it to test new all-time highs. The market loves this new strategic clarity, and we believe there's still more room for it to run as these catalysts start to play out.
And all of that brings us to our final rating. We are initiating coverage with a rating of outperform. Simple as that. The firm is executing flawlessly on a clear, smart strategy in what's shaping up to be a very favorable market.
And finally, for those of you who are interested, let's talk about a wild but plausible trade idea. So, what's the idea? Buying call options maybe 6 to 9 months out. The thesis, or the why, it's our belief that the market is still underestimating just how strong and long this M&A cycle could be. Now, the edge here is that we think options are still too cheap, just like they were before this last earnings report. They seem to be mispricing the potential for more of these upside surprises. Of course, there's always a risk. A big economic or geopolitical shock could just slam the brakes on all deal-making. But given the potential upside, we think the risk-reward profile here looks pretty compelling.
And as always, please remember, this is not financial advice.